If every country in the world is drowning in debt, then who exactly is all that money owed to? It's one of those questions that sounds simple, but the deeper you go, the stranger and darker the answer becomes. Because when you look at the global financial system and you follow the money, you realize something. The debt isn't owed to an outsider. It's owed within the system, to institutions, to other governments, and even to you. So let's unpack the mystery of how the entire world can be in debt at the exact same time. Let's start with a number that should honestly terrify everyone. Global debt has officially crossed $300 trillion. That's more than 256% of the world's GDP, meaning even if every country stopped spending on everything, no salaries, no infrastructure, no healthcare, nothing, and put every single dollar of economic output toward repaying debt, it would still take more than 2.5 years. And that's assuming the world economy magically stops shrinking while doing that, which it wouldn't. But here's where things get interesting. Advanced economies like the US, Japan, the UK, Italy, France, these aren't poor nations. These are wealthy, stable, developed economies, and yet their government debt has exploded to levels not seen in 80 years. Japan's debt is over 260% of GDP. The US is over $34 trillion and rising at the fastest pace in its history. The UK, Canada, Italy, France, all hitting historic highs. And emerging markets aren't far behind. Two-thirds of developing nations are in what institutions call debt distress, which is the polite economic term for their governments don't have enough money to pay the interest, let alone the debt itself. Countries like Ghana, Sri Lanka, Zambia have already defaulted. Others like Pakistan, Egypt, Tunisia are dangerously close. And yet, the global debt clock keeps spinning upward. Every government needs more money every year than it collects. That's the setup. Now we need to answer the real question. If every country is borrowing, who is lending? When governments borrow money, they don't go to one giant world bank and check out a loan like a library book. Instead, they issue government bonds. These are I O us, promises to repay money plus interest over time. But who buys these I O us? The answer is far more complicated and surprising than most people realize, because the lenders aren't some small elite group. They're everywhere in the financial system. A huge portion of government debt is held by domestic investors, pension funds, insurance companies, banks, and local investment funds. When the government owes trillions, a big portion of that is owed to retirees, savers, and institutions inside the country. Pension funds rely on government bonds because they're considered safe. Insurance companies need stable assets. Banks buy bonds because they're liquid and guaranteed. Index funds, mutual funds, bond ETFs, they all hold government debt. Meaning, when the government borrows, it borrows from its own people. Then you have foreign governments and investors. China holds over $800 billion in U.S. treasuries. Japan holds over $1 trillion. European countries hold each other's debt. Asian governments hold each other's debt. Global corporations, sovereign wealth funds, foreign banks, they all buy government bonds for stability. But they're not villains. They're investors seeking safety. And then you have central banks, the most mysterious and misunderstood holders of government debt. Central banks have the unique power to create money from nothing. Not symbolically, literally. When governments issue debt and private investors don't buy enough, central banks step in and buy the debt themselves. Where does the central bank get the money? It creates it. This is quantitative easing. The government issues debt. The central bank buys the debt. New money enters the economy. The Federal Reserve created over $4 trillion this way. The ECB created over 5 trillion euros. The Bank of Japan created so much money that it now owns over half of all Japanese government bonds. Half the nation's debt is owed to an institution that can never run out of money, never go bankrupt, and never demand repayment in a traditional sense. But if central banks can buy unlimited debt, why don't they eliminate it? Why not reset everything? To understand why, we need to understand what debt actually represents. Some people assume that if the world owes money to itself, everything cancels out. But that's not how the system works. Government debt isn't just a number, it's a contract. And for every debtor, there is a creditor. Pension funds, banks, investors, savers, insurance companies. If you erase government debt, you erase the assets of the institutions that hold it. Canceling debt isn't a reset. It's wiping out people's life savings. It would destroy pensions, retirement accounts, bank deposits, insurance payouts, investment portfolios. A debt jubilee isn't a celebration. It's a catastrophe. Debt also represents an intergenerational transfer. Every time a government borrows to pay today's expenses, it transfers the burden onto younger generations, future taxpayers, and citizens who aren't even born yet. Young people owe old people. Workers owe retirees. Future economic growth owes to past spending. Debt is the mechanism that financially connects generations over time. The most important part of the paradox is that the entire system survives on confidence. Government debt is the foundation of the banking system, the pension system, the insurance system, and the global financial system. If investors stop believing governments can repay, the system collapses instantly. That's why countries don't default voluntarily. That's why central banks buy unlimited debt. That's why the system can stretch and stretch and stretch until the moment people lose faith. Because the system doesn't run on money, it runs on trust. When trust collapses, the financial system collapses with it. So if every country is in debt, who is the money owed to? The answer isn't some shadowy outside entity. It's not a villain. It's not a secret group. The money is owed to your pension fund, your bank, your insurance company, your retirement plan, your central bank, other governments, global investors, institutions, savers, and future generations. The world owes money to itself. The system works until it doesn't, until the moment creditors, pension funds, banks, insurers, foreign governments no longer believe they will be repaid. When that moment comes, everything stops. So the real question isn't, who is the money owed to? The real question is, how long will the world continue believing the system still works? Because the second that belief breaks, the entire global financial system collapses. But to really understand why this system keeps expanding, why global debt rises year after year with no realistic path of repayment, we need to look at the incentives built into modern economies. Governments don't borrow because they're irresponsible. They borrow because the system forces them to. In almost every major economy, economic growth is the political lifeline of the country. Growth keeps unemployment low. Growth keeps living standards rising. Growth pays for healthcare, military budgets, social programs, infrastructure, education, and pensions. Without growth, governments get voted out, markets panic, and social stability cracks. But the brutal truth is this: real economic growth, actual productivity growth, has slowed dramatically across the world. Population growth is slowing. Productivity gains are stagnating. Automation increases efficiency, but it doesn't generate enough broad-based wage growth. So what do governments do when organic growth fails? They manufacture growth using debt. Debt becomes the engine that keeps the economy moving. When governments spend borrowed money, they inject fuel into the system. Businesses make more revenue. Workers get paid. Banks make loans. Investors earn returns. And that spending artificially boosts GDP. But it creates a trap. To keep the economy from shrinking, governments have to borrow more next year, and even more the year after that. Eventually, debt becomes the foundation of the economy itself. And once you build a system on a foundation of debt, you can't stop borrowing. Because if you stop, the entire structure collapses. This is why you hear economists say things like, deficits don't matter, or debt is sustainable as long as interest rates stay low. They're not being naive. They're acknowledging a hard truth. In the current global financial system, growth is impossible without expanding debt. Countries borrow not because they want to, but because the system collapses if they don't. And here's where the paradox becomes even stranger. When governments borrow money, they create an asset for someone else. Pension funds want bonds. Insurance companies want bonds. Bank portfolios require bonds. So the economy actually demands that governments stay in debt. If governments tried to pay off all their debt, financial institutions would lose their safest assets. The system literally depends on an endless supply of debt to remain stable. Think about how bizarre that is. We've built a global economy where debt isn't a problem. It's a requirement, which raises a deeper question. If governments must borrow and institutions must lend, then how does the system ever fail? Why do debt crises happen at all? The answer is hidden in a single word: confidence. Governments can carry massive debt loads indefinitely, as long as investors believe they can repay. Confidence is the currency of sovereign debt. When investors trust a government, they lend cheaply and easily. When trust breaks, interest rates skyrocket, borrowing becomes impossible, and default becomes inevitable. This is why wealthy countries rarely default outright. Investors believe the US, Japan, and Europe will always find a way to pay. But emerging markets, their credibility isn't as strong. The moment investors lose confidence, panic spreads, interest rates spike, capital flees, currencies collapse, governments can't roll over their debt. A crisis erupts overnight. This confidence dynamic explains why the US, with $34 trillion in debt, can borrow at low rates, while smaller nations collapse with far less. The United States issues debt in the global reserve currency. Investors treat it as the safest asset on earth. Japan's debt exceeds 250% of GDP, but Japanese investors keep buying because they have nowhere else to go. But for a developing country with weak institutions, debt becomes deadly. This brings us to the most confusing part of the entire system: the role of central banks in the sustaining confidence. The Federal Reserve, European Central Bank, and Bank of Japan act like the emergency buyers of last resort. When confidence collapses, they step in and buy massive amounts of government debt to stabilize the system. But their power creates another illusion. When central banks buy government bonds, they aren't just supporting the economy, they're hiding the true cost of government borrowing. Interest rates stay low not because the market demands it, but because the central bank is manipulating it. This means governments appear far more financially healthy than they truly are. In reality, central bank intervention creates a form of financial anesthesia. It numbs the pain of excessive borrowing. It hides the real risk. It allows countries to take on more and more debt without facing immediate consequences. But like any anesthesia, it wears off. When inflation rises, central banks must reverse course. They stop buying debt. They raise interest rates. Suddenly, governments face the true cost of their borrowing. And that's when the cracks appear. This is exactly what happened globally in 2023 to 2025. Inflation surged, rates spiked, and suddenly governments that were perfectly fine at 1% interest rates started collapsing at 6%. Debt wasn't the problem. The cost of debt was. This is what economists fear most: a world where governments must roll over trillions of dollars in debt every few years at increasingly high interest rates. The debt doesn't need to be repaid, but the interest does. And when interest consumes more and more of government budgets, something breaks. Countries must choose between cutting spending, raising taxes, or printing money. Cutting spending triggers political collapse. Raising taxes triggers voter revolt. So most governments choose the third option. They print money. But printing money to cover deficits weakens currencies, fuels inflation, and further erodes confidence, making the debt crisis worse. This is the cycle that ultimately destroys economies. Not the debt itself, but the loss of trust in a government's ability to manage it. So the real danger to the global financial system isn't the size of the debt. It's when investors, banks, pension funds, foreign governments, ordinary citizens look at a government and say, "I don't believe you anymore." Because the moment belief dies, the system dies with it. That's the fragile truth about global debt, a truth most people never hear. The world is not held together by money or gold or resources. It's held together by trust. And when trust breaks in one major economy, it spreads like wildfire. Debt markets freeze. Banks panic. Governments scramble. Investors rush to safety. A global chain reaction begins. Because in a world where every country owes money to every institution and every institution depends on government debt, one collapse can trigger the collapse of many. That's why the debt question fascinates so many people. It's not just a financial puzzle. It's the hidden architecture of the entire global system. Thanks for watching Finance Clarified. If you like explanations like this, hit subscribe, and I'll see you in the next one.